Okay, we're going to get started. Welcome everyone to the 30th Annual Apartment Perspective. Today's event is co-sponsored by the Southern California Rental Housing Association and the CCIM San Diego chapter. I'm Martin Kramer, CCIM chapter president and co-host of the event today. Before we introduce our speakers, we have a few announcements. First, a little housekeeping. Attendees, you are in listen-only mode, but you can use chat in the Q&A functions, and we ask that you use the Q&A box to submit questions for the panelists. This webinar is being recorded and will be shared with you following the event. We have set aside a half hour for the Q&A session and will conclude at 1:30 p.m. A little bit about CCIM. CCIM stands for Certified Commercial Investment Member. The CCIM lapel pin denotes that the wearer has completed advanced coursework in financial and market analysis, and 67% of CCIMs hold senior titles and earn twice as much in annual gross income than non-CCIMs. You can find out more about CCIM at ccimsandiego.com and follow us on our LinkedIn page for San Diego. Now I'd like to take a moment to recognize CCIM's generous sponsors. Our platinum sponsor of the program today is South Coast Commercial. South Coast Commercial is a specialized commercial brokerage and asset management company. SCC provides unparalleled performance to landlords, tenants, buyers, and sellers of commercial properties. Their team is dedicated to creating and defining investment strategies for commercial real estate professionals. We also want to thank our friends of CCIM for their ongoing support throughout the year. Our platinum sponsors are Chase Commercial Lending, Hex Solberg, Marcus and Millichap, Marsh Procopio, Marsh & McLennan, and Savills. Our gold sponsors are CoStar, Exeter 1031 Exchange Services, Langford and Associates, Pacific Medical Buildings, SES Engineers, and Slat Capital. On behalf of CCIM, thank you all for joining us today. Now I'd like to hand over the mic to Alan Pennico of the Southern California Rental Housing Association.
Thanks, Martin. Welcome. Welcome to the joint meeting between the Southern California Rental Housing Association, SCRHA, and CCIM Apartment Perspective. I am Alan Pennico, Executive Director of the Southern California Rental Housing Association, your co-host today. I'd like to start by saying that it's really great to work with CCIM on this program. SCRHA and CCIM have been very happy about this event for many years, 30 now to be exact. And this year we're bringing to you virtually. We do hope that next year we'll be able to meet in person again, as we all miss that personal contact. Let me just take a moment to thank our generous sponsors. Our platinum sponsors, Western Towing, Citywide Group of Companies, Inc., and the Phoenix Staffing Group. Gold sponsors, HD Supply, and our silver sponsors, Generation Contracting and Emergency Services, Inc., and Paul Davis Emergency Services of Temecula. Bronze sponsor, Chase Bank, Christy Blair Group. The Mark of Excellence Virtual Awards are coming up on December 3rd, 2020. We hope you'll be able to join us as we honor the best of the best in the rental housing industry. This is truly a great event that represents the top housing professionals in our region. At the SCRHA, we're still offering a tremendous amount of educational offerings, over 80 online webinars, and multiple classes on site in small groups of groups. And many of our webinars have recorded and are now available on our online store. Just log into www.socalrha.org and see what we have to offer. I've been asked to do a little bit of a legislative update today, so I would be remiss if I didn't take a moment to touch on the upcoming elections. There are a lot of votes you'll want to cast, but I want to draw your attention to Proposition 21. Voters across California are being asked to weigh in, again, on rent control in the state. You may remember from a few years ago, Prop 10 in 2018. This is a very similar proposition and threatens to undo the regulations that prevent local rent control laws from going too far. Prop 21 would remove the exemptions provided to single family homes, as well as remove your ability to reset rents at the vacancy. This is called D control. Make sure you vote no on Prop 21. It's my pleasure now to introduce to you Robert Valera, our moderator today. Robert is past president of the SoCal Rental Housing Association. He specializes in the brokerage of apartments within San Diego County. His career track record includes the sale or exchange of over 350 San Diego County apartment complexes. Robert's chief clients benefit from valuable insight and experiences he's gained through purchasing, operating, and improving over a dozen investment properties for his own account. Robert is a CCIM designee and senior vice president with Voight Services. On behalf of both organizations, we want to recognize and thank Robert for his dedication and contribution in planning and chairing this event for many years. Robert?
Thank you, Alan, and thank you, Martin. It's been 30 years now that we've been holding apartment perspectives, and we weren't about to skip this year, especially with everything that's been going on in 2020. We have wonderful speakers, Eduardo Velasquez, Miriam Castro, and Ben Vogelsang, who were selected based on specialized expertise that they have that can help illuminate both what's been going on in 2020, and also I think they're going to provide you with some insights that can help you prepare for 2021. I'd like to begin the program, if I may, by challenging you. Is 2020 really an unprecedented year, something entirely new, or is this just a continuation of a cycle of disruptions, at least one every decade, that frequently catch us by surprise? Those of you who've got a few decades under your belt already know that answer, right? 7 months ago, I think you all had an experience similar to mine, an awakening about this pandemic. Mine came in the second week of March. I called my little sister, my kid sister, who's a doctor at UCLA Medical Center. And I asked her, isn't this just like a bad flu? Is this really anything to be concerned about? My little kid sister figuratively sat her big brother down and gave him a lecture. And she described how little they knew about the virus, how sick people were getting, and what really caught my attention was the fact that they were already beginning to implement an emergency strategy to set up field hospitals. And, I got off that phone call and I looked at my wife, Holly, and I said, oh boy, here we go again. And really the effective word was the again. Ellen, if you can put up that first slide for us, and you'll see where I'm coming from about the comment about again. Before I really get into the contents of the slide, Terry Moore called me up a week ago and asked if I would be recommending a book. I frequently suggest books that are helpful for real estate investors. And at the time I told Terry, no, I'm not planning to do that. But over this past week, I did read a book I had first heard about. It was written up in the Wall Street Journal. They got their hands on an advanced copy and they reviewed it. It's only been out for a month or two. I'm going to hold it up, but the title's going to be reversed. I don't even know if it's going to show up with my blue screen in the background. It's called The Psychology of Money, Timeless Lessons on Wealth, Greed, and Happiness by Morgan Housel. And the book is powerful, and it's primarily about your relationship with money and how your behaviors, more than your technical knowledge of finance and investments, determine your financial success. It's equally applicable to those of you who are maybe trying to accumulate your first $100,000, might be in your 20s or 30s, as well as more senior investors, some out there who might be working on accumulating their first $100 million. In it, the author states, history helps us collaborate our expectations, study where people tend to go wrong, and offers a rough guide of what tends to work. But it is not in any way a map to the future. So if you want to take a look at one of those rough guides, and Alan, I'm not showing this the slide on my screen. I don't know if the rest of you in the audience can see it.
We see your 50 years disruption slide.
Yes, okay, all right. Some of the things I'll point out in that, for those of you who did not live through some of those prior disruptions, I'll go back into the ancient history of the 1970s, the Arab oil embargo. When I was a boy when this hit, but I do remember frequently 30 to 60 minute long lines at gas stations if it was your day to fill up, because you could only fill your tank every other day based on whether the digits on your license plate ended in an odd or even number. Odd numbers were designated certain days they could fill their tanks, even number license plates, other days they could fill their tanks. Was that unexpected? Yes. Did it catch everyone by surprise? Totally. Did we weather the storm? Yes, and we went into the inflationary 1970s. Real estate prices doubled and tripled here in San Diego during that decade. Then we went into the eventual high interest rates led to the credit crunch of the early 1980s. For about 3 years, new mortgages were effectively unavailable. If Home Fed was one of the few banks making home loans, if you could afford to pay 16.5%, 17% interest and 4 points, needless to say, there were a few takers, but we weathered that and we came out of it during the 1980s into the boom years of Reagan's presidency. We then got hit with the S&L crisis. What did that look like in San Diego? How about a 40% drop in the average selling price per unit of apartments between January of 1990 through December of 1995, and about 10% of the apartments being lost in foreclosure? But we came out of that into a very strong recovery, strong rising rents, strong rising property values, and a boom that went on until the Great Recession. Now, most of you are familiar with the Great Recession. You weathered that storm, and what was on the other side of it? One of the longest economic expansions we've seen in this country, a great bull market. So this time, relax. It's not different. It's just a variation on a repeating theme with some surprising details at play, as our speakers are going to explain. Our first speaker today, we're very fortunate to have with us, is Eduardo Velasquez. And although, before we get into that, Ellen, do you have a survey questionnaire for us? There we go. Before Eduardo comes up, I would like to survey the audience and let us know what role you play in the San Diego rental housing market. You'll see your options there. Go ahead and click it. Send it on in. And after Eduardo's done, I'll announce the results. Okay, getting back to Eduardo's introduction. Eduardo Velasquez is a research director for the San Diego Regional Economic Development Corporation, which is a nonprofit mobilizing business, government, and civic leaders to maximize the region's economic prosperity and global competitiveness. The EDC research team is responsible for analyzing the scale and depth of impact that industry and development have on the region's economy. Now, Eduardo leads EDC's inclusive growth initiative focused on skilled workers, quality jobs, and we all know how important that is in the apartment industry, and thriving households. He's also an elected member of his neighborhood planning group. And Eduardo, is that the North Park Neighborhood Planning Group?
Yep.
And he's a board member of Circulate San Diego. Prior to EDC, he worked as an economist for Wells Fargo Bank. He earned a master's degree in business economics, as well as a double bachelor's in business economics and law and society, all from the University of California at Santa Barbara. So once again, we're tapping the UCSB talent pool for the apartment perspective. One of the key reasons we've asked Eduardo to join us today is the EDC has been polling businesses through the pandemic, asking about key factors as far as how the pandemic is affecting them. And Eduardo can go into that in his presentation. Take it away, Eduardo.
Yeah, thanks, Robert. Appreciate the kind introduction there. You're absolutely right. We've been tracking the impacts of COVID and the subsequent shutdowns on our local economy from day one. We did reach out to businesses directly to understand what the anticipated shocks would be across industry, across our region. And obviously now that some time has lapsed, we have some concrete data from reliable sources where we can see what the impact is looking like in our region. So I'm going to walk through a couple of metrics on that front. The one thing I'll just add at the top is, as we look ahead and we anticipate this pandemic obviously enduring into the new year, we will be reaching out to the biggest employers and key industries in our region to better understand what decisions they're facing, what challenges they're facing, and what changes they might be making in the way they operate here in the region, to understand implications for workforce development, talent recruitment, space utilization, supply chain disruptions, and a whole host of other issues. So we'll be tracking the situation going forward and well into 2021. And for those of you in the audience, I hope you're all doing well and staying safe and sane in this very trying time. So with that, I'll just dive into these slides. On the next slide, just to kind of quickly summarize what the economy looks like today in our region. Specifically, the impact of this pandemic in San Diego's economy has been disproportionately concentrated on small businesses, hospitality industries for the most part, and people of color, both from a health and economic perspective. So, you know, a lot of things are obviously trending down. And a few things are trending up, but all of those positive, or upward trends rather, I should say, are not all positive. So we have seen record unemployment in the San Diego region. We very quickly surpassed the peak unemployment that was observed in the Great Recession. Despite that, home prices are still rising. Venture capital is still flowing into the region. And then, as I'll address as we move forward, we're seeing increasing inequality as a result of the way the pandemic is affecting different communities. On the next slide, I want to share with you kind of top line what we're looking at and concerned about for our region. Obviously, the way we do business, the way many businesses operate, is being dramatically impacted by COVID and the shutdowns and the changes in policy and restrictions. And so one very useful metric that is very difficult to track, but there's some good people at tracktherecovery.org that have pulled data from some proprietary data sets to show what business operations look like today. And so you can see this graphic illustrates the change in businesses that are operating in the San Diego region going back to the beginning of the year. Obviously, once the pandemic hit and the initial guidance was issued, there was a steep decline in the number of businesses that were open. We saw a dramatic decline in closures, or excuse me, a spike in closures in our region. Some return, so some temporary closures, you know, subsiding, and some businesses reopening as we got into a little bit of comfort with the way businesses might operate. Some reopening guidance was issued, and you see kind of around that 4th of July weekend, when a lot of California's restrictions were eased, you see a spike in the proportion of businesses that were open. But we have seen some resumption in closures in businesses in San Diego since then, as we've seen some spikes in cases and some retightening in the regulations and the requirements. So all in all, about 30% of of small businesses in our region are currently not operating. And again, it's hard to differentiate between temporary closures and permanent closures, but we are seeing anecdotal evidence, at least at the national level, that a lot of these temporary shutdowns are becoming permanent. Obviously, the magnitude of impact varies by industry. You'll see there that retail and transportation are a little more hard hit than the average small business, but by far leisure and hospitality is facing the brunt of this impact. On the next slide, I want to share what that translates in terms of jobs impact. And so this is coming from, the data you see here is coming from the most recent employment report that is issued by the state of California. We put out a monthly analysis the day that this report comes out, which you can find on our website. The next report will be out next Friday, a week from today. We'll have September data. So this is through August. And what this illustrates is that no sector has escaped the impact of COVID in terms of the job losses. Obviously, the bulk of it is concentrated in leisure and hospitality. You can see about 60,000 jobs lost compared to this time a year ago, or rather August to August a year ago. Some industry has seen some jobs come back in recent months, and that's what those green bars indicate, the monthly gains in the month of August. The dark blue bars indicate the year-over-year job losses that we're seeing across sector. All in all, we have 143,000 fewer jobs in our economy in August than we did in February prior to the virus hitting the region. On the next slide, I just want to illustrate what this looks like from a wage perspective. As you can see, the job losses have not been evenly distributed across the income spectrum. Low wage workers, those that earn less than $27,000 a year, have actually seen jobs disappear 18 times as quickly as their high wage peers. And so you can see there, overall, we've lost about 10% of employment. For low wage workers, it's closer to 30%. For high wage earners, those earning over $60,000 a year, the impact has been much smaller. And so what we're seeing is that the economic downturn that we're currently facing has sharply widened inequality in the San Diego region and in many metropolitan areas across the country. It's especially concerning because we know that those that hold these low wage jobs are people of color. And so we're seeing a disproportionate impact, not just on those based on income, but also in terms of race. Obviously, this job loss translates directly into reduced consumer spending. Consumer spending, all in all, in our region's down about 25–30% from the pre-pandemic levels. So it's definitely having ripple effects in our economy. On the next slide, you can see, though, one element that sort of bucks the trend is home prices. Obviously, mortgage rates are at even new record lows. I entered the workforce during the Great Recession and witnessed what we all thought at the time was the lowest that mortgage rates would ever go. We're seeing them significantly lower today. And then despite that record unemployment that we saw just a few months ago, although it's a bit better now, where in August, the unemployment rate stands at 9.9% for San Diego County. So we have seen some of those jobs return. Home prices continue to rise. And despite the fact that we're in a recession, I think the fact that interest rates are low, supply is very tight in this market, has been for some time. It's much tighter now. By one measure that I looked at, homes for sale inventory is down about somewhere between 25 and 40% this year compared to the same time a year ago. So I think the combination of low interest rates and low supply is what's allowing home prices to continue to rise in this unprecedented high unemployment era that we're currently going through. And it's not just the residential real estate market that's being impacted. On the next slide, you can see how commercial real estate is being impacted. We obviously care very much about the availability of space and the cost of space for businesses to operate in the region. This illustrates the early effects of the pandemic. So this data is only through the second quarter of 2020. We'll have third quarter data soon. But in the office space, at least, we've seen immediate effects as many office using employers have shifted their workforce to operate remotely, to not contract the virus. So we saw a very sharp increase in the vacancy rate for office space in the region, and that couldn't be worse timing in the sense that a lot of big projects are actually coming due in parts of our region, and so you see construction is up at the same time that utilization is down, and so the vacancy rate has jumped there, not just in the office space, but also in the industrial space. On the next slide, you'll see that we've seen a spike in vacancy rates there, not as dramatic as in the office space, but certainly an increase there. The dynamic in the industrial space is a bit interesting because we are hearing from some manufacturers in the region that they're actually looking at repurposing some of their space. So obviously manufacturing is one of those industries where you do need to be physically present to produce your goods. And so what some manufacturers in the region have told us is that they're actually looking at repurposing their office or administrative space and converting it into space used for production to allow their workers to have more spacing within the facility. So we don't yet see this in the data, but we're starting to anticipate that potentially we'll actually see demand for industrial space rise in the third quarter and beyond as those manufacturers look to stay operational but require more physical space to do so. And then finally, one bright spot for San Diego is venture capital. I mentioned at the top, the venture capital is up. We actually saw a really sharp spike in venture capital funding coming into the region in the second quarter. We kind of aggregate it here into two major buckets. Healthcare is a very broad definition here. It also includes life sciences and biotech companies. So in the most recent quarter that we have data for, the second quarter, we actually saw $1.2 billion come into the region in terms of venture capital, the highest we've seen in a couple of years and a big increase from the quarter prior. The bulk of that, about 75%, nearly $900 million went into the healthcare and life sciences. This is an indication, I think, of San Diego's strong position as it relates to the life sciences. We have a lot of strong companies, growing companies, both small and large in our region that focus on therapeutics and genomics and the like. A lot have pivoted toward therapeutics related to COVID, as well as the production of PPE. So I think all of that in response to COVID-19 has drawn additional capital into our region, specifically in those industries. And that's important because, as you'll see on the last slide, when we look at what's important for having a resilient recovery coming out of the recession that we're currently in, historically, what we refer to as the innovation economy, which includes the biotech space and the life sciences, that has been the driver of economic growth and economic recovery in our region. But it's not without challenges, not without headwinds. Ultimately, we're tracking three major things to make sure that our region will recover in a resilient way and continue to grow once we get it out of this recession. And it's making sure that the people that live in San Diego are well equipped and prepared to meet the demand of growing jobs, high paying jobs that are primarily concentrated in those innovation industries that I mentioned. And making sure that small businesses have a path forward to solvency and sustainability. One thing that we're looking at is how do we better connect small businesses to big customers, big buyers in the region, where that B2B relationship is one that they can operate within. And ultimately, we need to make sure we have the infrastructure that the economy needs for people to live and to thrive in the region. And so the things we'll be watching for as we come out of 2020 and into 2021 and things hopefully stabilize is making sure that we're finding a way to fill the jobs that are in demand, because we still do see some shortages for in-demand jobs, high-paying jobs, but the qualified talent is not readily available. So making sure that we're building that strong local talent pipeline. Supporting our small businesses. Historically, small businesses create about half of the jobs in the region. So that's a very important source of growth for our region. And then making sure that we're doing something to deal with the affordability challenges in our region. It's very difficult for an economy to recover and for an economy to grow if the people that live here can't actually afford to live here. So those are things that we'll be tracking and looking for. I know we got a Q&A session at the end, so I'll stick around, happy to answer questions. But with that, I'll turn it back over to you, Robert.
Wonderful. Thank you, Eduardo. Our next speaker is Marian Castro from Progress Management Company. Marian has been in the industry for 18 years, specifically in the multifamily sector for 13 years. Many of you know of Conrad Prebis, one of who's largest private owner of apartments in San Diego, who unfortunately passed a few years ago, but not before making a number of very generous grants and gifts to local charitable institutions. Marian is Director of Operations for Progress Management. She has been for the past 3 years. She's currently overseeing a portfolio of 5,800 apartments and 3,000 storage units. Those apartments are very well diversified geographically throughout San Diego County. So she has a lot of good reference points to speak from. Marian has a CAP certification. She was one of the first people in San Diego County, actually on the West Coast, to receive that certification. She's highly driven and focused. She enjoys being involved in the development of her employees and coaching them along, helping them achieve their career goals. And Marian can tell us a little bit more about Progress Management and about what she's encountering this year, she and her team, as they work to do the hard job of operating apartments under a pandemic situation. So Marian, please take it away.
Thank you, Robert. So as you mentioned, Progress Management company, we've been around for a little over 30 plus years, and you touched on the size of our portfolio. We have over 5,800 multifamily housing units and 3,000 storage units, and we are sprinkled all over San Diego County. Our portfolio primarily consists of C to B class categories. So with that, as you mentioned, this is my 13th year with the organization and my 3rd year as Director of Operations and Property Management. I've been humbled at the opportunity to lead such a hard-working and extraordinary team. It's fair to say that we are encountering unprecedented times, and the resilience and the grit that the team and that the industry has shown is unmeasurable. My goal has been to maintain the objective and vision that our founder, Conrad Prebis, laid out for the San Diego community, and that's with philanthropy and working with fellow San Diegans. Philanthropy and working with fellow San Diegans is at the heart of the organization. So thank you again. With that, COVID. So COVID enters our lives in March and turns our world upside down here at the operation level. Eviction moratoriums are put into place with continued extensions month after month through September. From March to April, between March and April, we witnessed a 6 to 7% decrease in rental payments across the county. What was really astonishing was that by May, we had seen that number drop to about 3.5%, and by June, that gap had closed even further, bringing it to just under 1%. It was really surprising to see that in July and August, we noticed that the rents coming in were remaining steady. And by September, it had looked like we were showing signs of nearing pre-pandemic levels for C and B class markets. During this entire time, rent deferrals were put into place. We had a temporary hold on rent increases from April through July, and a complete hold on all late fees, and still we continue to hold late fees, hold off on late fees for anyone that's been affected by COVID-19. So although many outlets and I can agree that the multi-housing sector is weathering the storm, There are some not so invisible costs that we haven't encountered and issued. Everyone is home. Everyone's working from home. Everyone's going to school from home. We were very surprised by the amount of calls and issues that both myself and my industry peers received regarding Wi-Fi connectivity, something that you wouldn't have thought to have been a problem, all of a sudden became a problem. Appliance replacement increased on average 18%. Everyone's home cooking breakfast, lunch, and dinner. And that led to the trash expenses increasing by 10%. And porter cost and services in an effort to maintain the demands mandated by both county and state officials with sanitizing common areas multiple times throughout the day. That also caused an increase in cost for those services. We saw 13% on that. And then, of course, the closure of the amenities causing frustration for everyone. When are we going to open the pools? When are we going to be able to reopen our gyms? And so it's definitely been a challenge. And again, we talk about the rents, but these are some of the added expenses that COVID has brought on to our sector. So recovery efforts between April and June, 7.5% of the tenants entered into a deferral agreement across the county. By September 2020, we noticed that 6% of those agreements had been recovered. There was a significant community outreach campaign in working with the affordable housing sector, working with several subsidy programs, caseworkers, and really making that connection between the tenants that were affected by COVID, whether they were experiencing a hardship from a financial hardship, medical, childcare needs. We launched an extensive campaign to get them the resources that they needed. So it's easy to say the big bad landlord, but I think with COVID, it doesn't discriminate. And it was absolutely a team effort between tenant and landlord in achieving such a recovery in regards to those deferral agreements. So everything's looking okay. And then AB 3088 comes into our lives in September. There is a lot of moving parts to AB 3088. I just here put some main points that I think are easy to follow. There's just a lot. We have the protected rent, which is rent owed from March 2020 through August 31st, 2020. We have the transitional rent, which is the rent that's owed from September 1st, 2020 through January 31st, 2021. There was an informational notice that was part of the mandate that needed to go out, and that had a deadline of September 30th. And along with that, a declaration of hardship notice that needed to be sent out at the same time, informing every leaseholder of their rights and their options during this pandemic. And so basically allowing them to reach out to their landlord and let us know if they were going through a hardship. We also had to put a halt on our typical 3-day notice to pay rent or quit, and had to get together with our legal team and put together 15-day notices to pay rent or quit for protected and transitional rent. Moving back quickly to the informational notice, another not so invisible cost. As you can imagine, having to get out that much postage and mail out was quite an expense on operations as well. And talking to my colleagues out in the industry, it was to get that out, and you can't send it by email, so it had to be mailed out. So AB 3088 has been hands down one of the most challenging mandates to work through. How this is going to be affecting us in the long run is still yet to be determined. Why? Well, Those 15-day notices that were sent out for the protected rent period are still live and have yet to expire. The 15-day notices for the transitional rent period are also still live and yet to be expired. So although we have started to see the trickling effect of our tenants that are submitting declaration notices in regards to their hardships, there's still a lot to be determined. And so we're waiting to see how that's going to pan out. Best practices during pandemic-related challenges in regards to working with our tenants. E-communication became, it was no longer, you know, an easier way to communicate. It was the way to communicate with our tenants. Virtual tours were preferred. We completely shut down in-person tours between March and June. And when we did bring them back up, it was, we had, of course, we did the socially distant, facial coverings, sanitation of all high-touch areas, and strongly encouraging the online payment method and online leasing methods to help avoid the hand-to-hand touching of paper and transferring of even just a pen, something you really don't think about unless you're actually dealing with a global pandemic. And strongly encouraging our tenants when they are in the office to practice social distancing, facial coverings, and personal hygiene by washing their hands often. Sanitation and safety measures were put into place when conducting work orders in occupied units. It's not on my slide, but there was some information that was sent out to all of the tenants, notifying them of what they needed to do when they had a maintenance technician or a vendor or anyone for that matter that was on the property management side of what to do to keep everyone safe. And so, of course, adhering to all CDC, county, state, and health safety guidelines. In regards to the employee practice, property management employees are considered essential workers. Therefore, when the rest of the county shut down, staying home for property managers and maintenance technicians and leaders just really wasn't an option. We had to come to work, and we had to be safe, and we needed to make sure that our employees were staying safe. So some of the best practices that we have implemented for our day-to-day operations, we're doing daily temperature and symptom checks before reporting to work. We have open communication with an employee if they're not feeling well. Typically, calling in sick is considered taboo. We encourage our employees, and so do many of my industry peers, to let us know if they're not feeling well. We'd rather them stay home and stay safe. Strongly mandating the social distancing practice, facial covering, and personal hygiene. An out-of-state policy was put into place, out-of-state travel policy, given that we share such a close border with Mexico, and Mexico and San Diego go together. So making sure that we had some practices in place for our employees, providing our employees with the safety equipment and the PPE needed to do their jobs safely. And of course, adhering to all CDC, county, and state health safety guidelines. And so we get to the current strength of the rental housing market. We've gone through COVID. We've talked about the not so invisible cost, recovery efforts, and working with the San Diego community, helping our tenants helping our tenants work with the San Diego community. The challenges and unknowns of AB 3088 and our best practices. So what does that mean for us now, right? Based on the last 6 months, we are expecting the next few months to perform fairly the same. In an effort to overcome the challenges of AB 3088, I strongly believe that tenant communication is going to be absolutely key. For those tenants returning declarations of hardships, in working with our tenants and working with local organizations and providing financial assistance is going to be paramount to their success and to our ability to weather the storm. We do see that rents across the county are rising once again. In the B class and C class sectors, we're seeing rents being bumped up on average 3 to 4%. Occupancy for B and C class markets have remained stable with occupancy ranging between 96 to 97%. My friends over in the A class community, they've experienced slightly higher vacancy rates, ranging between 94 to the 95% range, and we expect this trend to continue. A few key markets, San Marcos has seen an 8.9% increase in rents year over year. Escondido, 4.1% year over year. La Mesa has a 4% year over year rise in rents. Chula Vista has a 5.1% month over month. The city of San Diego, 2.9% month over month. And the city of Escondido, 2.7% month over month. And so with that, I really do appreciate the opportunity. Robert, thank you for putting this together, and Alan and Market, I appreciate the opportunity, and Ellen for helping navigate. I hope that you have all found the information provided helpful and useful. And with that, Robert, back to you.
Thank you, Marion. It's all of us who should be thanking you for taking the time to share your information with us today and provide us with those insights. While you were speaking, I had a little private chat going back and forth with Ellen Ernst from the from the CCIM chapter. And I should have left the screen up with the last question that we asked everyone about what their role was, whether they're investors, brokers, lenders, because software apparently doesn't capture and save the answer. So next time we have a survey question come out, we'll leave that screen up. After doing these apartment perspectives for a number of years, I have to admit I committed a rookie's mistake. Anyway, I think one of the things, Marion, I heard was maybe the biggest surprise about the pandemic is what hasn't happened. I'm going to be curious if our next speaker, Ben Vogelsang, is going to give us a similar outcome or not. Ben is a vice president and top producing apartment broker at South Coast Commercial. He's an honors graduate from the University of Washington in Seattle, where he also double majored in international political economy and political science. Those might be appropriate degrees for 2020. In college for 4 years, he started on the men's Husky lacrosse team. Ben's family has owned multifamily and industrial commercial real estate assets in California for almost 70 years, as well as owning and operating several family businesses ranging from construction to retail. So entrepreneurship runs in Ben's blood. He's successfully closed over 200 escrows, totaling over $500 million in apartment transactions. He's been the top producing broker at South Coast beginning in 2012, and then the dates just go on, 2013, 14, 15, 16, 17, 18, 19. Ben, have they already pre-printed the award for 2020 and maybe 2021, 2022?
No, they have not.
They've not. Okay, well, they might. Something tells me they might as well. Ben was also designated as one of the national 30 under 30 by Realtor Magazine in 2016. So he's come out of the gates hard and strong. We're very happy to have Ben Vogelsang with us today to talk about what's happening in the market, the for sale market in apartments in San Diego County. Ben, it's all yours.
Well, thank you for the kind words, Robert. So we'll start out here. Just a quick overview. I'm going to talk about lending. I'm not a lender. But I talk to clients daily and weekly that are going through loans. We're going to focus specifically on 5 or more unit multifamily all over San Diego County. And most of the content is CoStar data, or again, conversations I've had, over the last 4 to 8 months, call it, with private investors, mostly local private investors. So we'll start with 2020 before the shutdown. So the next slide has a quick comparison of Q1 of 2019 and 2020. Similar number of transactions, big difference in the actual sales volume. There's some large transactions that closed Q1 2019. And as we can see from a price per unit standpoint and price per square foot, pricing actually went up 3 or 4% year over year from Q1 2019 to Q1 2020. We saw cap rates compress and a little bit less of a discount off of list price. We did see the market time increase a little bit, which is not uncommon going through the winter and the holiday season. We also saw, a little bit higher gross rent multipliers. So market was going strong and going up. On the next slide, just some comments. There was some caution about AB 1482 from investors, but they were still able to execute value-add business plans. There's some good landlord legal advice. And again, the business model of renovating units was put on hold by a few investors, but not most. So again, lack of supply of for sale multifamily kept the market strong. Most long-term owners, if you can go back one, please. Sorry, I skipped ahead on my bullets. Most long-term owners made sure to raise the rents around 7% in 2019, and we're targeting that for 2020. There's a start in broker OM showing only a 7% increase year one after the investment was made, not 100% of market rents as we were always showing on projections. And appraisers are using that 7 to 8% rent increases. Again, AB 1482 didn't see too many effects on the market. I mean, a $100 rent increase on a $1,500 a month rents, roughly 7%. It's not too much for the tenant, and it's reasonable for the landlord from what I could experience, but there were some buyers that were out of the market. Next slide, please. So Q1 2020 lending, we saw 1.15 debt coverage ratio, a 5% vacancy factor. Didn't really hear the word collection loss. And we saw really high loan to value loans, which included cash out refinances, 70 to 75%. And interest rates on a 3, 5, 7-year fixed loan were in the mid to high 3% range. So at the time, again, it was historically low. Lenders did not require seasoned trailing financials, is one thing I noticed, after renovation during lease up. So you could have a 10-unit building that was remodeled and not have all 10 or even 9 units full and not have trailing financials during the renovation period and still get a pretty high LTV loan. There really weren't too many questions about collections unless there was a cause for a lender to ask. Next slide, please. And so mid-late March, the shutdown, most deals with open contingencies fell apart during this time frame. Really the only deals I saw that closed in April and May and a little bit into June were deals that had 1031 exchange buyers. They had a non-refundable deposit, release of all contingencies, and had been rate locked. Most of the deals that closed had a combination of these factors going. A big thing I noticed for the escrows that did make it through March, April, and May is a lot of buyers asked for rent guarantees or kind of a rent collection loss credit. For example, I had a $1.8 million deal where the buyer asked for about $100,000 in credits because they didn't think the tenants were going to pay April rent. It's a 7-unit building. All the tenants paid rent. Seller said no, and we closed on time. It was an exchange buyer, and they were very far along. So that was the deal that we saw close during this 2 or 2.5 month period. Going to the right side here, I thought it was interesting. The Sharks were out early. I mean, I had quite a few listings at the time. I was fortunate to still have them, as a lot were withdrawn. And I was getting verbal and written offers, a lot of letters of intent at 50 cents on the dollar, which I thought was interesting. And this was like 48 hours after the government shut down. So really soon, we hadn't even gotten into April. During this period, lending standards changed. So again, this was the cause for a lot of escrows falling apart. A lot of listings were withdrawn. I heard rumors of a lot of large institutional groups and REITs walking away from non-refundable deposits in other parts of the state and country. So investors pressed pause in April and May. There really wasn't a lot of activity on listings at this time. So next slide. A lot of changes in lending, late March to late May. And again, I think this is a huge catalyst for why it was slow. Obviously, there's some other factors. Very few new loans. Some lenders were completely out of the market during this time period. Most lenders' interest rates skyrocketed relatively to the high 4% or even 5% range on a 3, 5, or 7-year fixed. There's a lot of questions about collection data, tenant hardships, what had been submitted to the landlord, and the underwriting changed in escrow for a lot of deals that were being refinanced or potential purchases. Again, a lot of deals fell apart if they're in the early stages due to this. Just a note, our 4.29% cap rate from Q1 2020 would have been negative leverage with these new interest rates. So again, it makes sense why a lot of these deals fell apart. Next slide, please. So April and May, I use these quotes because this is what I was hearing on the phones talking to investors, both prospective clients and current clients. It was a period of price discovery and wait and see. A lot of uncertainty, a lot of fear, definitely was warranted. We're excluding closings in April and May because the deals that did close for the most part were locked in at pre-shutdown values. The few deals that were originated in this time period generally closed with a discount. It seemed that if an owner needed to sell, they were going to have to take a 10%, possibly more discount at that time to get it closed. Again, I was receiving very low offers on listings, 50, 60 cents on the dollar. There's a lot of speculation. Some people said the market wasn't going to change. Some people thought it was, like 1993. So no one really knew. Most owners had good collections, as we know. I still got scare tactics. I got forwarded a lot of economic information and to send to my sellers, which I didn't do. And I always asked the buyers, well, if things are that bad, how are your collections? And everybody was good, which is great to hear. People were coining the COVID discount with the seller sell at a COVID discount, and the answer was always no. Again, there was no distress, which is good. Next slide, please. So I'm going to refer to summer or the period June 1st to October 1st, again, clipping Q2 2020 and Q3 2020 as the summer for the purpose of this presentation. The next slide shows an article from CoStar showing how low the sales volume has been in 2020, specifically Q3. You can see there on the right, it's very, very low. And this was an article that I saved for this presentation. I thought it was very appropriate. So comparing June 1st to October 1st, so summer 2019 to summer 2020, we can see the number of transactions is down about 50%. Same with the sales volume. However, we can see the pricing is more or less the same, down about 1%. I wouldn't count that as being anything significant. Price per square foot is actually up, and we're seeing about the same amount of market time, about the same discount off list price, about the same cap rate. So what I'm seeing is better interest rates, same cap rate, better yield to investors, for the risk. But again, in summary, prices are about the same, number of transactions down about 50%. I also pulled transactions by deal size for the same June 1st, October 1st timeframe for 2019 and 2020. 60 to 64% were in that $1.5 million to $4.9 million price range. That's your 5 to 25 unit building roughly. And it was about the same number of transactions cut in half for each of these sizes, whether it's 5 or 10 million or more or under that $1.5 million. So not a huge effect there from what I can tell. The next slide is a graph on cap rates. So we saw them compress into Q1 2020. The deals that closed in Q2 were at a little bit higher cap rate, and now they've been coming down. Again, the earlier 4.6% cap rate did include June. So we're seeing them compress again in Q3, which is good for pricing. So really the reality of the situation again is sales prices are still strong. This is a graph on list price to closing price. So again, Q2, about a 10% discount for the deals that did close. There were some very motivated sellers, not many, but the ones that did sell did take a little bit of discount. Again, pricing has come up at least the difference between asking to sale price, especially since collections have been good and there's less fear about that. So next slide, we'll talk about what happened to lending in June. So lending opened up again. There's definitely more criteria, and lenders are looking into a lot of things they might not have before the shutdown. So the borrower profile matters more. Your liquidity and collections across your portfolio, not just specific to the property being refinanced, matter. Most lenders are asking for an upfront year's worth of prepaid principal and interest in a reserve account to be released and pay your principal and interest for the first 12 months. However, recently lenders have started releasing this back to borrowers early as of September, moving forward. So definitely more upfront costs, but it's getting a little bit looser compared to how it was starting in June. Some lenders are using 5% vacancy and collection loss, definitely not less than that. Some are using a higher vacancy and collection loss, and some are taking that 10 to 15% number or the 5% number off of actual collections, not of your gross scheduled income. And again, more lenders are asking for proof of collections. So we're seeing a 1.25 debt coverage ratio. So definitely not quite as tight as first quarter, but not bad. And on refinances, we're seeing 1.3 to 1.35 debt coverage ratio. Interest rates are in the mid 2s to the mid 3s. There's some great Fannie agency debt out there in the mid 2s, possibly even a little bit lower. Not really seeing 75%, max loan to value. We're seeing 60 to 65%. Not a lot of cash out refinances. Some, but not many. And again, a much lower loan to value. So next slide. Why did pricing hold up? Well, interest rates have gone down 50 to 100 basis points. There's still a lot of 1031 exchange money in the market. There's a lot of investors getting out of other markets, namely parts of Los Angeles or the Bay Area and coming down to San Diego. There's a lot of investors taking advantage of really high prices on single family or 2 to 4 unit rental properties and exchanging into 5 or more unit multifamilies, keeping the prices strong. We still have a lack of supply of for sale inventory. Collections again have been good. There's really no distress. Multifamily is seemingly much more stable than other commercial property types. And it's a good place for commercial investors to put their money. Value-added business models are still popular. I mean, I'm not on social media much, but it seems that, every time I do get on there, it's how I acquired X amount of doors in state, out of state, and renovated these properties. And it's kind of the buzzword these days. And a lot of buyers are trying to replicate the success that a lot of investors have had in the last 7 or 8 years with that business model. So next slide, a couple pie charts. Who's buying? Historically, about 60 to 65% of the sales were between a private investor and another private investor, or at least on one side of the transaction. We can see in 2019, there's a fair amount of private equity or institutional money involved in the market. Now it's pretty much all private. So a lot of these larger groups have, again, pressed pause. Next slide. So who is still buying and selling? It's a lot of the same buyers and sellers that you'd see in a more normal year. There's a lot of high net worth, high income investors that are getting tossed around in the stock market, or they want to diversify or want tax write-offs. And, they're getting in for real estate 101 reasons, if you will. There's definitely a shift in the buyer profile. There's newer and younger investors modeling these value-add business plans like I talked about before. Some of them are having trouble closing. Some of them are just getting their feet wet, but some of them are paying pretty strong prices and moving forward with the hopes of renovating post AB 3088. There's still some syndicators out there motivated by making fees. Again, some are tried and true in closing deals, and some are having some challenges. Let's see here. So who's not buying are many investors with out-of-state holdings, or they're buying in Arizona if they already own in Arizona. They're not necessarily selling here, but they're not looking in California due to current and proposed legislation. It's just a little high risk for a lot of people that have other out-of-state holdings. Who's selling? Again, typical seller motivations. We're seeing investors want to do a 1031 exchange before the end of 2020 due to that the 1031 exchange being eliminated possibly in the future. There's some investors that want to cash out this year due to potential higher taxes in the future. We're seeing some recent purchasers that bought a renovated building that are trying to resell for more. I don't know if some of these buildings are selling, some aren't. I have noticed kind of investors' sensitivity to listings. If a listing's priced really high, it's not moving. We're not having a market that's increasing. If you got a 6-month listing that was 5% overpriced, the market would catch up. You know, thankfully in the last 7 or 8 years, haven't really seen that. So listings priced to sell are getting multiple offers in some cases, 10 or 12 or 15. Again, there's no distress in multifamilies, stable. Long-term owners with low debt and low property taxes and good collections aren't really, they don't need to sell. So the next slide, who's selling our pie charts. Again, it's about 60 to 65% private historically. Now we're seeing a lot more private and a lot less institutional and public buyers. And then the next chart is just our for sale inventory. So there's 150 new listings for 5 or more units in San Diego County that came up Q3, which is a lot. You can see it's a little bit more than our trailing 6 quarters. And so where we're at now, in Q4 of 2020, we can see, and this is still Q3, I guess, but September 24th of 2020, the average asking price per unit, $319,000. We saw that the average price per unit on a sale was closer to $250,000. Similar cap rates. Obviously, the numbers can be a little different on marketing material or pro formas, et cetera. The average building that's listed, I think, is about 15.5 units. So it's still, a small to medium-sized building. And we are seeing that market time a little bit higher. Again, as of late September, there were 128 active listings for 5 or more units in the county. And then, so our next slide is, will there be more sellers? That's a question I get a lot. We haven't seen a sell-off or fire sales. There's really no reason why there would be. As stated in the previous slides, owners' motivations to sell are similar to a normal year, especially an election year. And there's really not foreseeable distress with interest rates so good and collections good. There was some hard money. Some investors had hard money loans on properties earlier this year and were in the middle of a renovation or lease up, and they were able to refinance, even in April and May. And then on the right side, I talk to a lot of owners, we all do, that are thinking of selling, but they're waiting for a certain event to happen or not happen. Is the pandemic going to be over at a certain date? When's the economy going to recover? Will eviction moratoriums be extended? And then there's always the elections. There's a lot of pause before early November. And so, in Q4, it seems that investors are requiring a better in-place income on acquisitions. I'm not really seeing 2 and 3 caps trade with a huge value add component. It needs to have positive yield with financing day one, month one. No one's really wanting to be, one non-paying tenant or a roof leak away from being negative with financing. So how I see deals being underwritten today is, no more 2 and 3% vacancy and collection loss. You gotta look at these deals with a 5% vacancy and collection loss. Definitely maintenance per unit, as Miriam mentioned, is higher. So lenders are using $750 to $900 per unit per year in maintenance, not $500. And we're actually seeing replacement reserves being used by a lot of syndicators and brokers. So just September and October investor sentiment, what I'm seeing is most people pushing pause. There's a lot of uncertainty with legislation and eviction moratoriums. Really, Prop 21 is the big one that everyone's talking about. Obviously, Prop 15 is a step in the wrong direction. It won't affect apartments from what I can tell, but it would be a step in the wrong direction here. And just really the question, how much can rents be raised given where the economy is? There are investors, again, questioning how thin the margins have become with a little bit worse collections, a little bit higher expenses for such an active investment. And there's, we always thought interest rates couldn't go lower. We might be where they actually can't go lower. I guess we have negative interest rates, but, and then lastly, there's a huge amount of capital sitting on the sideline waiting for distress or for a little bit of a price correction. I think if there is a correction, there's so much money waiting to buy apartments that I don't know if we'll see a change in pricing, but we'll see. So obviously that's a positive. And I'll end with just some questions that I think everybody's asking, and I don't have the answers to these. I wish I did, but these are really the questions that investors are asking before they decide to buy or sell or in the future. So how vulnerable is the market to interest rate increases? I think rates will be low for a long time, but sooner or later they're probably going to change. How will will rent growth outpace the cost of financing and operating expenses? How much can we push rents in the short term? How will an increased supply or concessions from Class A affect Class C? Is there going to be a trickle down one way or another? Will other product types be repurposed and add to the multifamily or have a mixed use concept and add to the housing supply? Same thing with ADUs. Some investors have been talking about that. Will that affect the apartment market? And then is there pent up for sale inventory, sellers that wanted to sell this year and they're waiting for a light at the end of the tunnel, or again after November? And then we haven't really battle tested AB 1482. Will it be a challenge to the value add business model? We don't have a lot of experience with it shutting down 2.5 months of the year. And then will there be an effect on rents and vacancy factors from increased home ownership, which we're seeing as well. So these are the biggest questions moving forward. Thank you for having me. Thank you, Robert.
Thank you, Ben. I think you might have front run our audience a little bit on those questions, but I will mention to the audience, we do have the Q&A box down the corner of your screen, so feel free to get questions coming in to us. But first, we have a question for you. It's a question that we typically ask at the Apartment Perspective each year, and it's a measure of our audience feelings towards 2021, towards the coming year. What's your sentiment in terms of the for sale price for apartments? You anticipating a rise next year, a decline, or do you think it'll remain flat? And this time I'll leave the window open until we have the answer in, okay? So go ahead, mark down your projection for next year, and let's see what we have. And as we begin to move into the Q&A, I'm also going to mention to our speakers, if you have questions of the other panelists, feel free to go ahead and be prepared to have a discussion among yourself. Okay. This is pretty similar to what we saw last year, big anticipation that we're going to have a flat market going into next year. What's really interesting, though, is we have more people think we're likely to see an increase in valuation than a decline in valuation. And I think that follows on a lot of the comments Ben was making regarding the amount of cash on the sidelines. A lot of that's probably cash looking for return with interest rate on alternative investments as low as it is. Okay, I'm not seeing open questions coming in for the audience, so I'm going to prime the pump with some questions here for our panelists. And I'd like to start out with the first question addressed to Eduardo. You mentioned that there's a talent shortfall in some particular fields in San Diego. What fields are those, Eduardo?
Yeah, that's a good question, Robert. I mean, they're mostly in STEM-related fields for the most part. I mean, perhaps not surprising to some of you. Software engineering is in high demand across all industry. We actually did a study earlier this year, right before the pandemic hit, focusing on the creative space. So traditional arts, but then also adjacent industries like computer graphic design, that kind of stuff. And what you find is no matter what industry you're looking at, the demand for software engineers is extremely high. And the so-called war on talent is a real thing that's happening across metro areas across the world. And so we compete for that talent. And right now we're just not generating enough of it here at home or keeping the graduates that go through our university system at a high enough rate. So we see those occupations being among the top in terms of in-demand occupations, high-paying occupations that are just not able to fill the positions as quickly as they would like.
Okay, thank you, Eduardo. Miriam, a question for you. To what extent, if any, have you had residents attempting to basically game the situation to avoid rent payments? And then there's a second part of that question. Do you have any concerns that AB 3038 will either initiate that problem or intensify that problem?
Yes, so to answer your first question, I would say we definitely have our fair share of tenants that are abusing the system. We're trying to work out other options with those tenants, whether it's we've floated around like a cash for keys option for someone that is making zero efforts to repay back the rent, and continuing that conversation. I will say that those declarations that I was talking about earlier, they are, it's a signed declaration under the penalty of perjury. So if someone is looking to take advantage of that, there are some serious consequences. So really trying to continue that conversation. I do believe AB 3088 is having a significant impact when it comes to handling those situations, and that's made our jobs much more difficult. So I know that there's the option of that protected rent becomes consumer debt, and there's the option of going to small claims court next year. I'm personally not very optimistic in regards to seeing any recovery on those funds, just because there's going to be an influx of cases, and there's just the way things are going. I'm just not very optimistic. But if I had to put a number on it, I would say we're talking for those specific tenants, less than 0.5%.
Okay.
Are.
And then you mentioned, and here's one of the surprises that we saw this year, and that was the rent delinquencies, initially jumped up a little bit and then decreased as we move further into the pandemic. Do you think how much of that, if any, is because tenants quickly adjusted, they doubled up, for example, they took matters into their own hands where they didn't want to be accruing debt, and so they moved? And then how much, if any, did the government assistance play a role in the tenants being able to maintain their rent payments?
Right. So one of the biggest, what we saw was the, again, for the tenants that genuinely don't want to go through this, having thousands and thousands of dollars of debt in past due rent, and we don't want to see that either. It was, as I mentioned earlier, really launching a community outreach campaign in assisting those tenants. Speaking on behalf of my portfolio, because my demographic is primarily C-class, B-class portfolio, that community outreach was extensive. Everything from whether it was, and it wasn't all just rent related. I mean, it was helping our tenants and guiding those tenants that are experiencing hardships to sources of where they can get childcare expenses covered, where they can get something as simple as pet food covered, and that would open up a little bit of that pocket for them to be able to pay their rent. And so, what was the second half of your question, Robert?
Well, this second half was, did it decrease because they made quick adjustment, or such as doubling up, or did the government assistance payments
Government
play a key
assistance,
role?
government assistance for sure. We, again, working with the local community, I think more so the local San Diego community. We're very well versed in working with various subsidy organizations throughout the San Diego County. And again, I can only speak on my portfolio in this particular arena because of my class, but we have strong working relationships with the Catholic Charities, Father Joe's, Jewish communities, PCG, just to name a few. We know some of these social workers by name. So when we saw that there was a tenant in need that maybe in the past, paid their rent on time, good job. But as Eduardo mentioned earlier, they were in the hospitality industry and lost their job. And so that's where the landlord stepped in to help. And I do believe that the only way we're going to get out of this recovery is continuing that tenant landlord partnership, where it's not the big bad landlord just wanting their rent. No, we're all San Diegans. We've all rented at some point. Some of us are still renting now. We have friends and family that are renting. We love our community. And so I think it was a little bit of everything, Robert. Some that had some savings, others that really looked to their local community for assistance. I think as San Diego, we continue to see time and time again where everyone rallies to help each other out. So, yeah.
Right. Thank you, Marian. Ben, your turn. We've obviously had a shift in politics in San Diego County, as well as much of the country over the last 20 years or so. I think we both have seen investors who have expanded their portfolios out of state. You touched on it briefly. I suspect we both have heard a lot of grumbling from investors in the past 12, 24 months regarding increasing government encroachment. Any acceleration in terms of investors taking additional funds out of state or making investments out of state for the first time?
So I don't have any tangible data on that. Unfortunately, I would say that just talking to investors, most seem that if they are going to do a 1031 exchange out of a current asset in San Diego or frankly anywhere in the country, they're not going to buy in California. I'm not seeing a lot of for sale inventory for this purpose, but I am seeing, if you're selling something in Los Angeles, you're looking in Arizona or Nevada or Texas. And it really has to do with kind of the landlord-tenant laws that don't exist there or exist here. So again, not really a sell-off. I'm seeing more interest in that from those groups. And it's kind of been a trend for, like you said, the last 12 or 24 months. Definitely there's more talk of it now. But again, most people are kind of in wait-and-see mode before they list their building in San Diego. But if they are making other acquisitions, they're looking, Florida's a popular one as well. So not a lot of tangible data yet, but definitely a lot more talk.
This is another question for Ben. You had also mentioned that there were flippers with short-term debt gone in and performed fix-ups on value-add plays on their apartments with the intent of just holding them short-term and selling. A number of them did have short-term debt and were able to refinance out. You also mentioned some of the aggressively priced apartments aren't selling right now. Have you heard from the fix and flip renovators whether they plan to become long-term holders, or do you anticipate there could be some price cuts on some of those renovated properties as needed to move them?
It seems that most are prepared to hold the buildings for long term. I think there's a lot of optimism, and there probably should be, that prices will go up. It might not be in the next 12 months, but in the somewhat short term, and they could exit if they want. If not, they're prepared to hold them. They have refinanced. Again, collections are pretty good. So it might not have been their original business model, but I believe that they're cash flowing well enough and servicing their debt. I think that could be something that is a motivation in the next couple of years for people to sell is if they did not plan on holding the building long term, they might be making a lower return than they wanted versus flipping, but we'll see. But not seeing a lot of price cuts. I think everyone's in a pretty good situation to be at least a short to medium term holder of their investment.
Okay. And then let me ask all three speakers, do you have any particular questions for each other? Nothing coming to mind? Come on, you're not going to try to stump each other here. All right. I think at this stage, I want to thank all three of you, Eduardo, Miriam, Ben, for coming on board today, sharing your expertise with us. It's been very valuable for our audience to hear. I'm going to make a closing comment before I do. I also want to thank the staff at CCIM, Ellen Ernst, over at the Rental Housing Association, Olivia Galvez and Alan Penico, who each year, the three of them, put a lot of work into helping put this together. This final comment goes back to the book I referenced earlier, The Psychology of Money by Morgan Housel. And he states that the correct lesson to learn from surprises is that the world is surprising. We should use past surprises as an admission that we have no idea what's going to happen next. How's that for 2020? The webinar was recorded. There's a slide deck that'll be made available in the next few days for the attendees. I'd like to thank all of you who joined us for the 30th Annual Apartment Perspective. Thank you for coming online today. We're sure looking forward to seeing all of you in person next year.
Thank you.
Thank you.
Thanks, take care.